Welcome to the next video, and we're going to be talking about the commercial bonds in the US as opposed to public debt, and I have certain worries about the health of this particular sector. I've mentioned it before in previous videos, and what I'm going to touch about is potential liquidity problems that are going to arise in the future in this particular sector. If we look at our particular graph here, pie chart, we can see that there's at least 5 trillion, 4.5 to 5 trillion of triple B, triple C, high yield bonds that, in my view, haven't been properly priced, and we're going to start seeing yields increase in those sections and sectors, and what we're going to see is follow-on effects in the liquidity side of things as we go down that route. So what we're going to examine today is a sector of the environment which has been growing, and I think is of extreme importance going forward, because bonds and the liquidity of bonds is an extremely important mechanism to make sure that the whole economy is functioning properly, certainly as far as liquidity is concerned. So if we have a problem in the bond sector, then we can see contagion in other asset classes as well. And for example, in 2007 and 8, what we saw was we saw that the stock market crash was more of a consequence of liquidity problems within mortgage-backed securities and another commercial paper like that. So what are we talking about? Are we talking about a financial crisis and a meltdown in bonds? Well, I think we're getting fairly close to that. As I said, we've got trillions of dollars worth of bad quality bonds out there that aren't considered necessarily as such by now, because the yields are so much lower than what they traditionally were for that particular asset class. What I'm going to look at is the particular trading structure that I think is seriously flawed, or liquidity structure that's seriously flawed, and its relationship in the ETF and authorized participant sector. Now, let me go into what we're talking about. There are two markets in that create liquidity as far as ETFs are concerned. Or is it not two markets? Well, there is. There's a primary market and a secondary market. And the primary market exists of institutions. Investors like you and I don't exist in it. It's primarily, as I say, a liquidity mechanism, and the liquidity is provided through arbitrage opportunities. And in this primary market, we have authorized participants, which are known as APs, and we have ETF sponsors, which are the originators of the investments that you and I as investors buy on the secondary market. Now, why is this important? It's because there are two different types of quality of liquidity between the primary and secondary market. The primary market is liquefied by the issuance and the redemption of shares, and the liquidity in the secondary market is in a sense independent of that as far as investors are concerned, but the supply of ETF shares for liquidity purposes is dependent on the relationship between the authorized participants and the ETF sponsors, which issues and redeems those shares. And that's really, really important as we go into further analysis of this video. Now, when we look at the creation and redemption of ETF shares, this is what actually is the mechanism, and the primary market is not as transparent as the secondary market. So this, to me, is the effect of transparency and the risks of primary liquidity that are of concern. And let me give you an example anyway so as you can understand it a bit better. Let's just look at the relationship and how the liquidity is created through arbitrage transactions between APs and the ETF sponsors. Let's just say we have an ETF and it's trading at a premium. So what basically happens is that the AP shorts the ETF. When they do that, they go long the underlying bond, or if they short a portfolio, they go long the underlying portfolio. At the closing trade, what happens is that the AP delivers the bond to the ETF sponsor. The ETF sponsor then issues new shares and redeems revokes the old shares, and new shares are created for trading in the secondary market. And what happens is then that the AP and also the AP delivers those shares to covers the short position basically with those new shares, and the difference is then the profit to the authorised participant. So that's how the shares are basically redeemed and created through this arbitrage process. And it all results in a profit for the authorised participant, and this is their reward for doing that. Now, this is all fine when we have a normalised, well, if you could call this current market normalised, but anyway, in a market that has had risk inadequately priced and subjugated, in my thoughts. Now, this mechanism hasn't been tested fully in a crisis situation. And a lot of pundits, a lot of people out there say that it's irrelevant because there will always be arbitrage between the sponsors and the authorised participants. Well, I disagree with that. And the reason why I disagree with that is because as we looked at that bond profile before in the pie chart, as we start seeing the ratings of those particular commercial bonds that are not sick at the moment but are lesser than investment grade, when the rates go up, they're going to have greater problems in financing these bonds simply because that their companies have become less efficient because they've been fed on cheap money. Well, when cheap money is no longer cheap money, they've got to get profits, and if those profits aren't there because they've been subsidised by cheap money, it's a vicious circle. So the market is then going to hammer the value of those bonds because the value of the companies are going to go down because they can't finance through cheap finance. Vicious circle. So when you've also got to consider when these bonds go down and some of them start becoming fallen angels, you're going to see the APs, which are not obligated to provide liquidity to the market. They have massive, because they're banks and financial institutions, they've got massive bond portfolios. They're going to start managing their portfolios because they've got to manage the risk within those portfolios. Therefore, they will step back from providing liquidity to the ETF sponsors, and hence the shares that are available for purchase and redemption are going to be less. So this will cause not just a product crisis but also a liquidity crisis in the secondary market. And this is something that has to be looked at because this is not something that's just going to affect ETFs as investments. This is going to affect the commercial bond, the bond sector. It's something that has to be really looked at. So when QE was in full swing, what we've seen, because volatility was lessened, risk spreads were also less. This, for example, as political risk increases in Europe and as well, we're going to see factors that come into play here that haven't been before, and this is certainly worth looking at as far as liquidity is concerned. Now, is this liquidity crisis possible? Of course it's possible. Everything's possible in the financial market system because disasters only happen after the event. People have never seemed to predict it. I mean, 2007 and 2008 was a perfect example. So as the fallen angels numbers increase, as the bond rates increase, and as the underlying company efficiency in terms of its operations decrease, we're going to see pressure on company liquidity, bond liquidity, and financial liquidity. And this is a very, very dangerous mix. And anything that's a dangerous mix in the bond market is something you as investors have to be wary of. And could we see a credit crunch in the bond market? Yes, we could. And that's pretty scary. So keep an eye on this bond market. Keep an eye on the risk spreads. Keep an eye on the ETFs. Keep an eye on whether the authorised participants are starting to manage their bond portfolios, because then those are the danger signals, and just be careful of that. Thank you so much for watching this video today, and we will be producing the next video very, very soon. Thank you again for your time and your patience, and please subscribe to my channel. Thank you. Bye.